Somewhere in your life right now, there is an account with your name on it that you have not thought about in years. An old savings bond in a drawer, a retirement account from a job you left decades ago, an annuity you bought in your 50s and stopped watching. Here is the payoff up front. Sitting still is not the same as being safe. There are 5 specific kinds of accounts, and with each one, doing absolutely nothing is the single most expensive choice available to you, and the danger is not a new law aimed at seniors. There is no such thing here. The danger is a rule that has been sitting in the tax code for years, working exactly as written, waiting for one line on one tax return to turn years of silence into a bill you never saw coming. Today I am walking through all 5, what actually triggers the bill, and the deadline that genuinely matters, which is not a new regulation, it is simply the calendar. My name is Robert Hensley, and every week I go through the actual rules that decide what happens to money like this. Because nobody sends a letter explaining any of it until the year it actually lands on your return. And by then, the decision that would have prevented it is already behind you. I am not here to sell you anything, and if you are new here, hit subscribe and tap the bell now, since new videos post every Wednesday and Sunday. One honest note before we start, you almost certainly do not have all 5 of these, and that is completely normal. If you have even one, the next few minutes are worth your time, and if you have none at all, you will still know exactly what to look for on behalf of someone you love. Let us start with the one hiding in the most literal drawer of all. Account number 1, savings bonds. Millions of households have them, bought as gifts, bought through payroll at work, bought for grandchildren, bought decades ago during a savings drive. And they sit in envelopes, safe deposit boxes, and the backs of filing cabinets, doing what everyone assumes, quietly growing. Here is what almost nobody checks. Every savings bond has a final maturity date, and once it arrives, the bond simply stops earning interest entirely. It does not shrink, and it does not disappear. It just stops, silently, with no letter ever mailed to tell you it happened, and the paper in your drawer looks exactly the same the day after as it did the day before. The exact schedule depends on the series and the issue date. Some series stop earning after a set number of years, while others continue longer, and the rules were different in different eras. So 2 bonds bought a decade apart can behave completely differently. Which means you cannot go by feel here. You have to check the series and issue date on each one individually. Picture a woman named Alberta, 74, who inherited a stack of savings bonds from her mother and added a few of her own over the years through payroll deductions. The interest on those bonds had been building up untaxed the entire time, sometimes for decades, since savings bond interest is tax-deferred until you actually redeem it. When her roof needed replacing, she took the whole envelope to the bank and cashed every bond in one afternoon. Decades of accumulated interest landed on that single tax return at once, pushed her into a higher bracket, and increased how much of her Social Security became taxable that same year. If she had spread those redemptions across 2 tax years instead of one afternoon, the same bonds and the same roof would have cost meaningfully less in tax. Find your bonds this week. Check the series and issue date on each one. And if you have a large stack with real accumulated interest, talk to whoever prepares your taxes about spreading the redemptions across more than 1 year before you cash a single one. Account number 2, and this one can genuinely be taken away from you entirely. An old retirement account at a company you left years ago. One you know exists, but have not received a statement from in a long time. often because your mailing address on file is outdated after a move or two. Here's where it goes. If an account sits inactive long enough and the company cannot reach you, it can be turned over to your state as unclaimed property, a process called escheatment. For most account types, that is not a disaster. The state simply holds your money until you claim it back. No harm done beyond the inconvenience. For a retirement account specifically, something else happens on the way out. Federal law treats that escheatment as a taxable distribution, confirmed directly in IRS guidance, meaning it creates taxable income in your name that same year, whether you asked for it, wanted it, or even knew it happened at all. Picture a man named Reginald, 71, who left a small retirement account behind after 9 years at a company decades ago, a balance he genuinely intended to deal with someday. 2 moves and a name change later, the statements were going to an address where a different family now lives entirely. The account went dormant. Then it was escheated to the state, and Reginald found out from a tax document reporting income he had never received. In a year, it pushed him into a higher bracket for the first time in his life. Here is the correction almost nobody tells people in his position. He can still claim that money back directly from the state. And here's the part that gets missed constantly. If he does it promptly, he can actually roll those reclaimed funds back into a retirement account and avoid the tax entirely, using a self-certification process under federal rollover rules, rather than simply accepting the tax bill as final and permanent. The single highest value habit that prevents this from ever happening in the first place is keeping your current address and phone number on file with every retirement account you have, checked once a year on a date you actually remember. If that surprised you, hit like right now so this reaches somebody who has an old account sitting somewhere. And if you haven't already, subscribe, since I will keep covering exactly this kind of rule nobody mails to your house. Now, back to the list. Account number 3, and this is the most misunderstood item on this entire list. An annuity you bought with regular money, not inside a retirement account. Just money you already had sitting around. A lot of people bought these in their 50s or 60s. Somebody explained it sounded safe, it grew without being taxed each year, and it has been sitting there since, untouched, exactly as intended. Here's the part people get backward. That growth is not tax-free, it is tax-deferred. And those 2 words look similar, but mean something completely different. Tax-free means never taxed. Tax-deferred means tax later. And later has a way of arriving at the worst possible moment. When you take money out of a non-qualified annuity, you do not get your original contribution back first, the way most people assume. The gains come out first, every single dollar of them, taxed at ordinary income rates, the same rates that apply to a paycheck, not the lower rates that apply to long-term investments. Picture a woman named Opal, 73, who put money into an annuity nearly 2 decades ago, specifically because it had grown steadily since. Exactly the outcome she was hoping for. When her air conditioning failed and she needed a real amount of money quickly, she withdrew from the annuity, assuming she was taking out her own original contribution, the money she had personally put in years earlier. Under the actual rule, she was withdrawing pure gains, every dollar of it taxed as ordinary income in that single year, on top of a repair bill she had already budgeted for separately and was not expecting to pair with a tax bill. She was fortunate that her surrender period had long since ended, since many contracts charge a real penalty for withdrawals during their early years, a penalty that can land in the same month as the tax bill for somebody who bought more recently and had not yet cleared that window. There is one more detail worth knowing for your own family. When a non-qualified annuity passes to somebody other than a spouse, The built-up gains do not get the favorable step-up in value that many other inherited assets receive. The deferred tax simply moves to whoever inherits it, sometimes catching them by surprise at an already difficult time. Account number 4 has a real deadline attached that catches people right at retirement: a health savings account. If you ever had a high-deductible health plan, you may have one, and it is genuinely the most tax-advantaged account in the entire tax code. Money goes in untaxed, grows untaxed, and comes out untaxed for medical costs. 3 layers. Nothing else in American finance does that. The trap is entirely about timing. You cannot contribute to one of these once you are enrolled in Medicare. That part is fairly well known. Here is the part almost nobody knows. When you enroll in Medicare Part A after turning 65, that coverage can be applied retroactively, backdated up to 6 months, though never earlier than the month you actually turned 65. Confirmed directly from federal guidance, and it is a regulatory policy, not a change written into law. Any contribution made during those retroactively covered months becomes an excess contribution after the fact, through absolutely no fault of your own, since everything was correct on the exact day you made it. Picture a man named Vernon, 68, who kept working past 65 because he liked the job and the insurance was good, contributing to his health savings account right up until he retired, exactly as he had for years. When he enrolled in Medicare, coverage reached backward into the months he had already been contributing, turning perfectly legal contributions into excess contributions after the fact. Excess contributions carry a 6% excise tax for every year they remain uncorrected, and Vernon did not know it had happened until his tax preparer told him the following spring. If you are past 65, still working and still contributing, stop contributing several months before you enroll in Medicare, and ask specifically about the retroactive period before you file anything. Now here is the good news almost nobody uses. After 65, you can withdraw from this account for any reason at all, without the usual penalty, paying only ordinary income tax on non-medical withdrawals. There is no deadline on reimbursing yourself for a qualified medical expense from years earlier, which means old receipts you kept are effectively a stack of tax-free withdrawals waiting to be claimed. Account number 5, and this is the one most people know about and still leave alone for years. A retirement account had a former employer that you never rolled over. Not one you forgot existed. One you get statements from every year and simply never moved, out of inertia more than any actual decision. Here is why that matters more than people think. While that money sits inside a former employer's plan, the plan's own rules govern it, not yours, including what the plan is allowed to do with a small, inactive balance sitting there year after year. Many plans are permitted to force out small balances after you leave, and very small balances can be cashed out entirely without your ongoing input, which converts retirement money into ordinary taxable income the moment it happens, regardless of whether you wanted that outcome. Picture a woman named Mabel, 66, who left a modest balance at a manufacturing job from decades earlier and always knew it was there. When the company restructured its retirement plan, her small balance was automatically forced out under the plan's own rules, and a check arrived. Being practical, she deposited it, and in doing that without realizing it, she converted retirement money into a single year of ordinary taxable income. There is a window, generally 60 days from when you receive a distribution like that, to move it into another retirement account and undo the tax consequence entirely. But Mabel did not know the window existed until it had already closed. If you have money at a former employer, decide deliberately whether to leave it or move it on purpose rather than by default. And if a retirement check ever arrives unexpectedly, do not deposit it into checking and think about it later. Call somebody that same week instead. Here is the deadline I promised you, and I want to be honest about it rather than dress it up. There is no single new law reaching into all 5 of these accounts on one specific date. What decides the outcome for every one of them is the tax year itself. Cash a bond in December, the interest lands on this year's return. Cash it in January, it lands on next year's. Take an annuity withdrawal in a year your income is already high, it costs more. Take it in a lower income year, it costs less. Which means the real deadline is simply the turn of the calendar, the same one it always is. And everything you decide before that turn lands in one tax year, everything after lands in the next. Here is your plan, and none of it requires a professional to start today. Find your savings bonds this week. Check the series and issue date on each one, and do not cash a large stack all in one year. List every employer you ever had a retirement plan with, and search your state's unclaimed property database under every name you have used. It is free and takes minutes. If you own an annuity, call and ask for 2 numbers, what you put in and what it is worth today, and write them down before you ever need the money. If you are past 65 and still contributing to a health savings account, stop several months before enrolling in Medicare and ask specifically about the retroactive period. And if you have money at a former employer, make a deliberate decision about it, on purpose, before the calendar decides for you. Let us recap quickly. Savings bonds stop earning at final maturity, and their interest can land on one tax return all at once if cashed together. Old retirement accounts can be escheated to the state and taxed as a distribution, though reclaimed funds can often be rolled back into a retirement account if you act promptly. Non-qualified annuities pay out gains first at ordinary rates, not your original contribution. Health savings accounts carry a real retroactive trap tied to Medicare enrollment. And old employer plans can force out small balances that become taxable the moment you deposit, rather than roll them over. Everything in this video is general education, not personal tax advice for your specific accounts. So confirm your own numbers and deadlines with a tax professional before making any decision. If you know someone with an old account sitting quietly somewhere, share this video with them today. And if you have got a question about your own situation, drop it in the comments. Every Friday, I answer real viewer questions over on my Posts tab. If this helped you, hit that subscribe button and the bell so you catch every video the moment it goes live. Quiet is not the same as safe, and now you know exactly why. This channel provides educational information only and is not affiliated with the Social Security Administration, Medicare, CMS, the IRS, or any bank.